Imagine you are 18 years old and you decide to put your very first paycheck into the stock market. The year is 1985. For a couple of years, your money goes up and your friends think you are a financial genius. Then, Black Monday hits. Wall Street suffers its biggest one-day drop in history, plunging the market into absolute chaos. Your friends beg you to sell everything. You ignore them. The market recovers, only to dive straight into the dot-com bubble. The Nasdaq goes into freefall as technology stocks collapse, and the exact same people are on their knees pleading with you to pull your money out before you lose it all. You hold strong again. Then comes 2008, bringing a global financial crisis and the worst economic downturn since the Great Depression. You survive that, and a decade later, the 2020 pandemic crash wipes out global valuations overnight. Everyone agrees this is the end of the stock market. But as the world reopens, the market instantly soars 27% from its low, setting completely new records. By ignoring the panic and holding on to those investments through 4 decades of financial terror, this specific portfolio averaged an 11.23% return every single year. This timeline chart plots exactly what happens with that return rate. Contributing a flat $250 a month, your total balance completely dwarfs those deposits, pushing straight through every market crash to peak at over $1.8 million. That scenario is my actual personal financial record. I was that 18-year-old beginner back in 1985. Surviving the stock market does not require you to predict the future. It only requires you to endure temporary catastrophes so you can capture long-term mathematical growth. Before you buy a single stock, you have to build a specific foundation. You need a cash emergency fund sitting in a bank account that covers 3 to 5 months of your living expenses. This cash buffer is your survival mechanism. If you lose your job during an economic recession, this prevents you from being forced to sell your stocks at a massive loss just to pay your rent. Once the buffer is built, you need to open a tax-advantaged account. In the UK, these are known as Stocks and Shares ISAs, and in the US, they are Roth IRAs. These specific accounts act as a legal shield. They completely protect your long-term profits from being drained by government capital gains taxes. Without this exact foundation, a cash buffer, and a tax shield, any wealth you generate in the market is completely vulnerable to sudden life emergencies and heavy taxation. Now we need an investment vehicle that eliminates the need to pick winning stocks. That vehicle is an index fund, specifically the S&P 500, which tracks the largest public companies in the United States. Think of this list exactly like a radio music chart. The better a song performs, the higher it climbs. If a song loses popularity, it drops off the chart entirely. The S&P 500 automatically does this with businesses. If a company performs poorly, it gets removed and replaced by a rising competitor. When you buy an index fund, you are simultaneously buying a tiny fraction of every single dominant company on that list with one click. If one business fails, your money is safe because it is spread across all of them. Index funds are mathematically safer than picking individual stocks because the index automatically trims its own losers and promotes its winners without any effort from you. When I first started, I had to physically phone a stockbroker every single time I wanted to make a trade. Today, you can execute this entire strategy in 5 minutes on a smartphone app. You link your bank account, select the S&P 500, and set up a small, automated daily or monthly investment. My son ran a test doing this with just £5 a day, roughly the cost of a daily coffee. When you configure this automated buy, you need to explicitly select the version of the fund labeled accumulation rather than distribution. An accumulation fund takes any cash dividends paid out by the companies and automatically reinvests them back into buying more stock. This actively accelerates your compound growth over time. True wealth generation is completely passive. Once you activate that daily automated buy, the most profitable thing you can do is close the app and forget it exists. This side-by-side comparison shows the math behind 40 years of automated investing. Contributing just £250 a month means you put in $94,000 of your own cash. Compound growth turns that initial capital into a massive £3.56 million portfolio. People often worry about inflation eroding their money, but as long as you are continuously investing capital rather than leaving it stagnant in a checking account, your growth will outpace inflation. This methodical approach is the exact opposite of what quick day traders do. They pore over complex price charts and technical patterns, enduring massive stress while trying to time the market's minute-by-minute swings. Beginners see people make millions off viral meme stocks and try to replicate those lottery ticket wins by picking individual companies. Day trading is a gamble on short-term chaos. Index investing is a calculated bet on the long-term fundamentals of the global economy. This growth chart shows the brutal cost of hesitation. An investor contributing a single amount every month starting at age 25 secures an enormous portfolio by retirement. Look at the massive drop in final wealth for someone who waits an extra 10 years to begin. The formula is straightforward. Build a diversified portfolio of index funds, automate your contributions so you never have to think about them, and refuse to sell during inevitable market crashes. Building generational wealth is an endurance sport. You win by starting early, holding your ground, and letting time do the heavy lifting.